Hello, this is Alex again with MasterChartsTrading.com, and this is market recap for Friday, October 23rd, 2015. This week, markets continued to rally, and this was quite a surprise for many people, myself included. The market breadth improved significantly further, but is it enough? And we will take a long-term look at the S&P 500 and trend identification in general, and I'll show some interesting indicators that I created. QQQ, the Nasdaq 100 ETF, is nearing all-time highs, and Apple is reporting on August 27th, so that could be an interesting point for QQQ and the general market as well. So far, bonds are unimpressed with the stock market rally, and they basically held firm. Dollar held support from last week and popped higher. And also, gold, oil, and natural gas all came under selling pressure as the dollar rallied. All right, let's look at the charts. So this is a chart of S&P 500 ETF SPY, and you can see this was quite a powerful rally off the lows in late September up until today and Friday. Now, today we had a pretty sizable gap up, about over 1% up in the morning, and actually we held support throughout the day. But this kind of large gap after a sizable move like this could mean that this is an exhaustion gap. And at this point of the game, even though we had a very nice big rally and we had breadth picture improves still even further, but I'm still not yet 100% convinced that we are out of the woods yet. So you can see that the red line, the 50-day moving average, is below this green dotted line, which is a 200-day moving average. So this is still a bearish cross, a death cross here. Let's look at some of the indicators. Last week I pointed out this breadth momentum oscillator, and if I consider the security to be still bearish, this overbought reading could be like a prelude to it rolling over, because this is an oscillator and it oscillates within positive negative territory. If it starts to drop lower, especially below its 10-day exponential moving average, this blue line, then we may see lower prices ahead. Same with MACD. It's in a positive territory, and actually it's quite overbought. Some of the readings from even when the bull market was in full swing is approaching this reading already. So we are quite overbought after this pretty sizable move. So at the very least, we'll see, most likely we'll see a pullback very soon. Could be that we're actually going to renew a push lower and take out this low and possibly this low. And next several charts I'll go over some of the charts that I look at, and the indicators that I use to clarify the direction of the stock market. So this is a 11 months chart of S&P 500, the actual underlying index, SPX. You can see a very similar rally here of the lows of October. Several of the breadth indicators that I look at is the percentage of stocks above the 50-day exponential moving average and the percentage of stocks above the 200-day exponential moving average. Notice that the percentage of stocks above the 200-day EMA has not yet recaptured plus 60% mark, and it has dropped below 40, but has not yet reached the 60% mark. So it's one of the lagging indicators still. However, the bullish percent index had indeed hit plus 60% mark, so this is now in the bullish camp again until proven otherwise. And so there is some underlying breadth improvements, certainly. But once again, we have this 50-day EMA below the 200-day EMA, so at the very least, I consider this to be somewhat bearish. Okay, next chart, I wanted to look at a very long-term picture of the S&P 500. So this is a graph of the S&P 500 with price removed, and I only left the moving averages in place. And since basically I follow the trend following approach to stock markets, to trading stocks, is that I first identify a major underlying trend of a security and then trade in the direction of the trend. So during the bull markets, I would look for long opportunities, and during the bear markets, I would look for short opportunities. S&P 500 is has a relatively easy way of identifying bull and bear markets, because it's just a relatively smooth security, and it enters the bull markets and bear markets more or less. You can kind of clearly identify them compared to some other ones. For example, QQQ is more difficult to trade. But here we have, first of all, if we're going to set our bias by looking at the moving average crossovers, then we would have had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 long-term bias changes. But you can notice here that even though we had a crossover in the moving averages, these 4 crossovers here were not confirmed by the breadth indicators. And I use breadth for New York Stock Exchange composite and for NASDAQ, as well. And then another indicator, this one right here, this one I created myself, and this shows percent of stocks within a index in an uptrend. So this is kind of like a custom indicator that I created. And this is surprisingly, it has good predictive value. So together with the moving average crossovers, with the breadth for New York Stock Exchange and for NASDAQ, and together with this custom indicator that I created, I was able to exclude these 4 whipsaws. So in other words, these 4 whipsaws would not have occurred if I used breadth to confirm or deny my hypothesis of a major trend change. So which leaves us with just the arrows, the up and down arrows. The blue arrows denote bull markets, while the red arrows denote the bear markets. Now, at this point of the game, as of today, we have a bearish moving average crossover. We have breadth for NASDAQ and for New York Stock Exchange Composite still being confirming the negative bearish crossover, together with the percent of stock in an uptrend indicator also still confirming the bearish bias. And so far, none of these 4 indicators have negated the bearish signal. Now, they could negate it sometime soon, but they have not done so yet. So until this happens, and this is, as you can see, quite a robust set of indicators, I will keep my bearish bias until proven otherwise. Okay, next chart we're looking at is a QQQ, the NASDAQ 100 ETF. So as I like to point out, in the past I pointed this out, stocks, and especially stock indices and ETFs, have just very large correlations to one another. So S&P 500, you can see, correlates 98% of the time to QQQ. So for all practical purposes, they are very highly correlated. And even though QQQ appears to be stronger than S&P 500 because it's really getting close to all-time highs. I think that if S&P 500 rolls over, QQQ is very likely to follow. QQQ is again also very overbought within a potential bigger downtrend. You can see this red line is below this green line, etc., as I pointed out just a few minutes ago. So once again, we're very overbought, and we have not yet seen a retest of this rebound. And once we see a test of this rebound, and if we, for example, don't hold this low, we could easily see a retest of this low from August. Again, advanced decline lines did improve. The advanced decline volume line did improve, and so there is improvement in underlying breadth. Now, I wanted to point out that QQQ has a very high, it's a very top-heavy fund. Notice that Apple accounts for 12% of this fund. S&P 500 only accounts for 3%. Apple in S&P 500 only accounts for 3%. So you can see that 50% of this ETF QQQ is concentrated in the top 10 holdings: Apple, Microsoft, Amazon, Facebook, Google, two Googles, etc. So it's doing great if these 10 stocks are performing well, but as you know, if you trade QQQ, then you probably want to look at the very least at the top 10 holdings and see how they're performing. And next I wanted to show Apple. So Apple is an 11-month chart. It accounts for almost over 12% of QQQ. So first of all, we had several rejections here at around $130 with multiple bearish engulfing patterns, and the latest one of which resulted in quite a nasty sell-off. So you can see 50 days now below the 200 days, so you can consider Apple to be in a bear market. Now, Apple reports on October 27th, so we can see that there is now a strong run-up into the earnings. Could this be a setup for a disappointing earnings? It has happened in the past. I believe this is an earnings report as well, and you can see there was a nice run-up to the all-time highs, and then this happened. So we could still easily be disappointed by earnings and roll over. If this happens, then certainly the larger QQQ will certainly come under selling pressure as well. Next, let's look at bonds. This is a Barclays iShares aggregate bond fund, and you can see that bonds are really not impressed with the rally in the S&P 500, and there is still quite a bit of fear, if you ask me, because people are buying bonds. And I ask myself a question: why would people be interested in buying bonds if S&P 500 is nearing all-time highs? And I think that's because there's still quite a bit of fear and uncertainty in the stock markets in general. Let's next look at the dollar index, US dollar, as traded on the FXCM foreign exchange forex product. So last week I pointed out this pattern here as support was being tested. This support and this support was being tested by the US dollar. It obviously held support and rallied really hard. And then China cut its rate today on Friday, announced that it was going to cut the rate, and dollar obviously rallied even further because this is bullish for the dollar. It is not yet overbought, I don't think so, and we could easily break out above these highs and continue further to 52-week highs. So this will most likely weigh on various commodities, so let's look at gold next. All right, so this is gold S&P spot price daily chart. First of all, this is still a bearish security in my opinion. This is still a bear market rally of these lows here. So this is a multi-year low, and we had a pretty sizable rally of the lows. Now here, last week we actually closed above this green line, which is a 200-day moving average, and the last time this happened was back in May, and exactly the same thing. I said, is this really a breakout? And then the gold came up and fell back down, and we had a multi-year lows. Now again we're rallying above the 200-day moving average, and looks like the price so far has been rejected. Today, Friday, was really a wild day. You can see a very large range fluctuation here, and it's still sliding down. Now this support level, or rather this resistance level, when this possible breakout happened, now may be acting as support. So this buying tails here out the bottom is, I guess, a sign that we're being at support right now, and should we break down, should the support not hold, we could easily fall back to this area here, to 1100, and possibly again retest all multi-year lows. Now if the support holds, we could potentially continue higher. If we continue higher and break out above these highs here, I will need to reevaluate my whole posture on gold. At this moment right now, I think this is a bearish security, but if we break out further and possibly the 50-day moving average moves above the 200-day moving average, then I may need to reevaluate. Now let's look at GDX, Gold Miners ETF. Very volatile action here. This is, 5% move, 3% move, 4%. So very volatile action here. No clear winner that I'm aware of. This just kind of like sideways. I think they call it a violent disagreement between bears and bulls. My money is on a bearish territory, because you can see we're in a long-term bear market for gold and gold miners. There is as before, the red moving average below the green moving average. Now gold miners have breadth data associated with them, and you can see we hit a new low in advanced decline lines, advanced decline volume line. You can see there's a divergence going on with advanced decline lines moving lower while the price is sort of moving higher, I guess you can say. So it's a mixed picture. Unbalanced volume is possibly showing accumulation. It's difficult to say. And then, as before, I showed this indicator as before, gold minus bullish percent index. We hit very oversold levels here back in August and September, and rallied from there. Now we're at 43, and as I mentioned before, my threshold for bullish is around 60%. For the gold minus bullish percent index. So we'll see if we continue the rally, and if we hit the 60% mark. It's possible we may continue higher to maybe this 200-day moving average, but there is a lot of resistance here in this area now. All right, next on the commodity front, let's look at oil, West Texas Intermediate crude oil. Several weeks ago, we had a shooting star candlestick here at exactly the 200-day moving average. So this is a kind of classic rejection candle, followed next day by confirmation with a large red candlestick and continuation lower. I think last week I mentioned that we may found support here at the 50-day moving average and rebounded, but clearly that did not hold well, and actually we closed below the 50-day moving average on Friday. This is rather ominous looking, and this support here at around $43, if there is going to be a close below this $43 area, there probably going to be a flood of orders triggering sell orders, and prices may again retest this multi-year low. Let me see. It looks like unbalanced volume is actually pushing lower, so that's like a leading indicator. Excuse me. Finally, natural gas. I pointed out this pattern last week. This is a classic rising wedge following a large move down. We had a rebound in the form of a wedge. Then came a wedge break right here, a slight rebound, and a plunge lower. And this is a multi-year lows. So certainly very strong move of this highs in August. This is over 20% move. So at this point of the game, we're certainly very oversold. So I would not be surprised if we, the very least, rebound to the broken support here at $2.40. But in general, this is a bearish security, so I would be looking for short setups again if there is a rebound that takes place. All right, let me quickly show you how to find us on the internet. Please go to MasterChartsTrading.com. I wanted to say that we have trade alert services that are active, so please subscribe to our trade alert services. They're well worth the money you're going to get. I provide my actual buys and sells that I do, and I send out notification to the subscribers of what I actually bought or sold. Also, we have a blog, and of course this will be posted there in the video section, and this video should be posted there as well. If you go to public charts and social page, there is a public chart page which you can click, and it will take you to the charts page where many of the charts that I mentioned are located. If you have Twitter, Facebook, YouTube, StockTwits accounts, please follow us there as well, and also subscribe to our mailing list. That's it for this week's recap. Thanks for watching, and have another great trading week. Bye bye.